I'm very excited to welcome today's guest, Laura Inamedinova. Laura is an award-winning serial entrepreneur, investor, and keynote speaker. Laura has a dual role within the Gate ecosystem. In her position as CGEO, she builds cross-border partnerships, and as a principal at Gate Ventures, she oversees investments, partnerships, and development of the fund. Before joining Gate, Laura built a successful Web3 marketing agency, scaled it to 8 figures, and exited. This led her to be globally acclaimed as one of the 10 women entrepreneurs by Entrepreneur magazine and among the top 10 women in international business by Silicon Valley Times. She was also named one of Forbes 30 under 30 blockchain visionaries. And on a personal level, Laura is a successful angel investor with over 40 projects in her portfolio. Hi, Laura. Thank you for joining us today. Let's start broad. What's the current state of Web3 venture capital globally, and where do you see smart capital flowing right now?
Well, first of all, happy to be here. And you start right in with easy questions. So when it comes to the current state of venture capital, it's actually very interesting market we're at. So last couple of cycles, we had retail kind of driving the narrative. When we think about any kind of investment, we would always think like, hey, venture capital would come in, give the initial liquidity for the project to grow, to build their team, and then they would do the token launch, and then basically the community would come in, the retail will come, and in the end, unfortunately, it would be an exit liquidity for a lot of venture capital funds. Whereas right now, as there's not a lot of liquidity, as you know, majority of token launches are not doing well. We had very, very big layer ones and other big companies launching within the last 6 to 9 months. And yeah, you might have one or two green candles on the launch, but then everything would crash. And usually would crash, unfortunately, in a horrible way. So right now, we're kind of shifting our focus from investing in tokens to investing in revenue generating companies. We prioritize right now companies that have a clear path to acquiring users, clients who have a clear understanding how they're going to be generating revenue and down the line profits rather than launching a token. So in a lot of cases, we don't even care about the token anymore, and we care more about the underlying business models. And this is very different to previous cycles where a business model would be the second second important thing after the token. Another thing, what we see right now is institutional adoption is growing. Right now, majority of liquidity coming in from institutional players, would it be funds, would be ETFs right now are super hot. We also see a lot of liquidity coming in from capital markets. So again, the industry is maturing and money coming in is already doing the research and looking for interesting use cases to back, not just expecting a 10x return if the token pumps. We had, of course, meme coins for a little while that helped the retail to get some rewards, but the problem is it was an unsustainable market. It was a very short kind of window where, in the end, I personally think it was gambling rather than value-based investing. But right now, I see stable coins, RWA as two kind of most interesting industries to invest in. And actually, before coming here, I was looking at the new report, State of Crypto by A16 Z Crypto. I highly recommend for anyone to look into it. And what they're showing is money is flowing in majority of time stable coins and RWAs. Tether, USDC are dominating the markets. We have a lot of treasury companies that are coming in. Interesting thing, not just in Bitcoin holdings, but in Ethereum holdings as well. And Solana holdings also increased within the last couple of quarters. We see a lot of companies are coming and doing IPOs as well. And we predict there's going to be a lot of IPOs happening throughout this and next year. So industry is maturing and venture capital is maturing together.
Fantastic. And so with kind of that macro view in mind, the macro conditions have been pretty tough on many founders, and certainly working on the ground with Solana, we've seen that firsthand. So how are global market conditions shaping where VCs deploy capital right now?
So, you're saying macro conditions are bad for the founders. I do not agree. I would change the quote to market conditions are bad for the wrong founders. If you are the founder with a track record, with experience, with unique use case, you have no issues to raise capital. The problem is throughout the last couple of cycles, we have learned this helplessness in the space where founders with mediocre ideas would raise not because they're doing something well, because there's nowhere to invest. So I'm in the space since 2016, and I've seen horrible projects start 16 to 18, raise 10, 20, 30 million because it's a new industry. No one understood. Everyone was expecting for anything to pump, and it did. Whereas right now, as the market is maturing, investors are becoming much more smarter, and they're looking for founders with experience. So if you're a founder with a track record, you have worked in the space beforehand, you have exited, or you're building something really unique, you will raise capital easily. But if you're a wannabe, you have no prior or experience in the space, or your idea is not as strong as the market wants, of course you're going to be struggling. So it's just like the market is shifting to more mature founders. And coming to the second part of your question about VC capital deployment, there's another kind of narrative that is going through what everything what I've kind of discussed is VCs are usually getting the worst terms. So when you come on a cap table for any of the projects, VCs usually get 12 months lockup. They have year or 2 years cliff. So realistically, if we invest right now, we're only going to get tokens in 1 to 2 years from now. And if we go back to the previous statement I made, that majority of token launches fail because they launch at a very high FDVs, we're doing a simple math. Will we A, get our principal back, and B, get some sort of multiplier for either LPs? I mean, here we invest more our own prop capital, but majority of VCs are investing LP capital, and the answer is no. So they are shifting their focus. If it's not a revenue generating company where you can get returns from potential future profit, they're focusing on liquid strategies. They're focused on discounted OTCs, or they also focus on liquidity provision. So right now you can get 20-30% APY on your Bitcoin holdings, and if we predict that Bitcoin is going to be growing and it's not yet at the end of the bull market, it can give you a 50-60% return per year, which is realistically much more that you can get investing in early stage projects right now.
And so you've spoken about that sort of evolution, looking more towards revenue generation. You spoke about founders that have had previous exits. So in your mind, overarchingly, what makes a crypto deal worth backing today, and what specific signals beyond what we've discussed do you look for in a founder or a project?
So right now, I'm very cautious when it comes to investing. I think coming into the market for almost 10th year, next year is going to be 10 years as in the crypto market. I've done on my personal level probably like 60 or 70 angel investments throughout all of those years. And now I'm being way more cautious. Now I choose to do more liquidity provision. I choose to play in liquid strategies. But if I do investment, either it's my own personal capital or if I'm recommending for the fund to invest, first of all, I'm looking for the experience and the track record. Unfortunately, a lot of founders still to this day come and want to solve the problem. They have no experience solving. They don't understand their narrative they're building. And like, if I come on a call and I know more about the narrative than a founder, why would I back them? So I want to come to a call, sit there for those 30 minutes when a founder is pitching and be like, damn, I know nothing. I'm being educated. Like, a founder needs to teach me something. We'd be like, okay, they definitely know more and they definitely understand what kind of problem they're solving. Then it's also about the valuations. Really high early stage valuations are unsustainable from venture perspective. So again, very simple math. If you're a founder raising at, let's say, 30 to 50 mil valuation at your seed, means you're going to be raising Series A at like 100 to 200, it means you'll be planning to do your token launch at $500 million valuation. If you're launching at $500 million, how will you sustain the price? How will you sustain the price? Probably not. And if you're doing, KL rounds, if you're doing community rounds, and you're gonna have a lot of unlocks on TGE or within a short period after, your token's gonna pump. It's gonna not gonna pump, but gonna plummet. Where is the multiplier? Okay, let's forget the multipliers. Getting principal back. The high FDVs are not sustainable in this market, so I'm looking for very reasonable founders. Usually, if it's early stage, it should be below 10 mil in valuation, and someone who's not chasing the high numbers, but chasing actually users, revenue, and show the actual need for the product they're building.
Okay, great. And so, you've spoken about effectively creating token economic models that purport to kind of chase that hype and aren't sustainable in that mind. And so in the interest of chasing hype and trends, AI has been a bit of a dominant theme this year, but we've seen the majority of these AI agents are effectively GPT wrappers. So in your opinion, where can AI create real opportunities in Web3 apart from these AI agents? And where do you see that intersection flowing?
So when it comes to AI, I'm bullish and bearish at the same time. I'm bearish because, as you say yourself, there are too many just ChatGPT wrappers. But on the other hand, if it's a ChatGPT wrapper with an amazing distribution channel, why not? Because in the end, it's all about distribution. If you create a better UX, a better UI, you find a specific use case, and you have the community who wants your product, and yes, it is a ChatGPT wrapper, I don't care because the product is going to be good. So the biggest question is, when it comes to any AI product, is what exactly are you building, and do you have a technical understanding to build it, and B, the resources? Because I think when was it, like 4 or 5 months ago, we saw this meme on Twitter where Meta was hiring all these engineers and paying them outrageous amounts of hundreds of millions, whatever, for signing up for them. Like, best AI talent is incredibly expensive. And if you're an early stage startup, you cannot afford it. So when these founders come to me with these ambitious ideas, my biggest question is, where will you get the talent to build it? And is your talent going to be enough to realize that grand ambition idea? And sometimes a simple AI wrapper, maybe even an AI agent that already has customers, that already have very clear pipeline of clients, they have probably some sort of already revenue coming in from use case, looks really good for me. They're making, in the end, if you're making money, even with a very simple product, you're going to be miles away compared to someone who just has an ambitious idea, but no clear path on distribution.
It comes back to those core principles that you touched on earlier on. So, stepping back a second, when it comes to tokens, we've discussed effectively like the turn-offs around the kind of token deals and warrant agreements et al. But what features make a design attractive to investors?
So when it comes to token design, I feel like this question was asked so many times within the last years. Key thing is utility. Why do you actually need a token? And maybe you can be an incredible blockchain company that utilizes technology without the need of token. And the thing is, founders love a token because it gives them additional liquidity. They want to do a TG, they want to launch the token, and they want to get the returns of it. But realistically, just build a good product. Don't look at the old ways how the industry kind of came here, how the industry grew. Look what's relevant right now, and it's product, very clear use case for that product, very clear problem that you're solving, and then the target audience who will die to get the solution. And if you have that, if the token is needed to sustain whatever you're building, sure, then you put it. But 80% of projects do not need a token, and they can fully sustain themselves without it. But just for need additional liquidity, they choose to have it. So again, it's not about, finding the right use case that I like as an investor. It's more like, hey, does it make sense or not? And if you want me to invest in a token, what are the mechanics that will make the token pump, or make the token needed and circulating? And if you say, oh, it's a governance, no one really cares about governance.
Seconded, certainly. And so, beyond the tokenomics and financials, speaking again around the investability of a founder, we discussed, a distribution channel. We discussed a previous track record. But let's come to soft skills a second. What signals around the soft skills of that founder show you that they are truly investable?
Well, that's a hard question. It's when it comes, social media really glamorizes what's like to be a founder. You probably see these videos on TikTok or Instagram. I woke up in the morning, I got my coffee, I just did a deal. Now I'm here, on this Lamborghini. Like, I mean, I'm based in Dubai. I see these kind of horse seller founders at every corner. Just go to the palm and you see them. Being a founder is not a luxury. It's a very, very hard job that you need to hustle, and you need to prioritize founding a company over anything else. And I'm saying that from experience. I was a founder myself. I had a marketing agency that I exited successfully. And when you do that, you have sleepless nights. You prioritize your business over your friends, your family. This is your baby that you need to grow to a certain level until you can, take a little bit of the step back. So first thing, what I'm looking for the founder is, do they have this hustle mentality and the mentality of just doing whatever needs to be done to get the result? And it's not fun. It's not glamorous. It's not 9 to 5. It's 12 hours a day, every day. And when founders come to me and they pitch me and I'm asking them all these questions, are you ready? Like, oh, I don't know, but I have this, I have these hobbies, I have this and that. I'm like, yeah, but you're asking me to invest $1 million. That $1 million that someone worked many years to achieve, now give to you, and you want to work, 9 to 5 and go on vacation 3 months out of the year. Like, hey, it doesn't work this way. And it sounds, obvious and maybe even very comedic, but that's unfortunately the reality. It takes so much work. So when it comes to first key soft skill is really having that resilience, that grit, and that hustle mentality to do whatever it takes. So that's kind of number one. Number two is being a good storyteller and being very charismatic. That's another very important thing for a founder, because in the end, the founder, especially the CEO, needs to sell the product, needs to sell the vision. They need to close the first partners, investors, first employees. And when I'm hearing someone pitch, I ask myself, would I want to work for this person? If I would be me 10 years ago, needing a job, would the story from this person make me like, yes, I believe in that vision? So I always look into that as well. It's like, do I believe in the founder and their vision? And does it make me move? That's second. So I feel so very, very good at in storytelling. And charisma. You need to have a lot of charisma as a CEO, because in the end, at the early stage, you're not selling your product, you're selling yourself and your team. Do we believe in that specific person? Because again, majority of companies, they pivot. Whatever they start with is not necessarily what they end up having success with. But is the team so good to scale it, pivot it, do whatever it takes, and I believe in them specifically? And number three is again what I mentioned before, is just market knowledge. Do they really understand the space? Do they know all the competitors? Do they know all the potential partners? And have they sat down with their clients, or with their potential users, spend time with them, and then come to me, let's say as an investor, when they're pitching, say, yes, I spoke with 20, 30, 50 people who need this particular product and they can't live without it. I know exactly what their pain points are. I know exactly what they need. And that's why I'm building this. And again, it sounds counterintuitive, but it's not. I've had numerous founders when they pitch me, especially if they're in like early stage, there's not a lot of traction. There's not a lot of MVP. They might not even have, the budget, but they have time. You have time to sit down, go on LinkedIn, and reach out to 100, 200, 300, 500. I mean, there is even like scrapers you can do. You need to do it, manually, and get calls, get conversations going with your potential users, and they don't. And I'm like, so you didn't really do your market research. So you think that you need this product, but you haven't talked with like 50 people, and you're wanting again to raise a few millions to build something you didn't get validated. So that's another very important skill, is really understanding the market and being able to see it not just from the founder's perspective, but also from the client's perspective.
And certainly everything you're saying rings true to a lot of the VC sentiment across the board right now. And I mean, we're filming this right now from Solana's build station. So what advice would you give to the founders building in the Solana build station right now, and certainly builders across other ecosystems?
So whoever's building in Solana, they're definitely in the right chains. I was yesterday in the event here in Japan that was organized by Pantera Capital, and I was talking with their new president Scott, and he was telling me how Pantera now his thesis on Solana, and they are being very bullish on it. And that's one of the very amazing indicators when one of the largest and well-respected funds are being basically building their thesis on Solana. Something as good is about to happen, and they're one of the first funds in Bitcoin, by the way, back in like, when was it, 20 years ago or so, 15. I'm very bad with math. So if you're right now building on Solana, key thing what I would advise is take advantage of all the super teams. I've personally worked with a Dubai super team, I've worked with Polish super team, I've worked with British super team, and I had really good experiences there. And there are a lot of incredible people who are here to help you, and you need to utilize those resources. Solana has, I mean, I don't work for Solana, but I can advocate for a lot of things you guys are doing. You have your own breakpoint, you have some hackathons as well. So really to utilize the community, and there are a lot of Solana maxis who only invest in projects that are built on this chain. So you definitely need to take advantage of that. And in the end, if you're building on the other chain, you can always go cross chain. So make sure you choose the chains that are giving you the most benefit and who can really support you as a builder from early days.
I'm totally aligned. And I think certainly quite often venture, when they're scaling and they're looking at distribution, they often overcomplicate the communication, right? The end user doesn't need to know blockchain is even being used, but selecting a chain that is right for the business is absolutely critical. So finally, if you had one piece of advice to give Web3 founders who want to survive the next cycle, what would it be?
So bull markets are for selling, bear markets are for building. So right now we're kind of on the sunset of our bear market. We don't know how long it's gonna last, probably till the end of the year, maybe Q1 if we get lucky, Q2-ish. We never know. I mean, if I would know. I mean, I wouldn't be probably sitting here. You need to raise capital right now, build all the right relationships, get traction, and have enough capital to survive the next bear market, which is going to be very cold. So you want to have the right team, the right people positioned to have a very clear strategy, what you're building, what you're doing for the next 2 to 3 years, because only those who are going to be surviving those next couple of years of the bear market are going to succeed in the next bull market. If you haven't launched right now, you have a very short window. Launch, raise, go then into hibernation mode of building, and come out strong in the next cycle. But you need to prepare to have enough runway for 2 to 3 years.
I don't think there's a better way to highlight the grit, really, than to get through the bear market and show the tangible results and even revenue generation to an extent. Exactly.